Welcome. In this video, can ZBCN coin increase 1,300% in a bull wave? We will analyze this. Don't forget to subscribe and like, and please watch to the end to understand.
First of all, the descending curves or downtrend lines we see on charts play an extremely critical role in helping investors understand price movements. A descending curve essentially shows that the price is constantly reacting at lower levels, meaning buyers are weak and sellers are dominant. It is one of the clearest visual structures that reflect this. If an asset makes a lower high with every attempt, it signals that the asset is in a downtrend and sellers are maintaining control. However, every descending curve also carries the potential for reversal. Investors focus on whether the price breaks this descending curve because such a breakout usually indicates that an important psychological threshold in the market has been crossed, that sellers are losing strength, and that buyers are preparing to step in. Therefore, the phrase, "the price needs to break the descending curve," is not just a technical statement, but also a powerful expression of market psychology. The existence of a descending curve means that the price has consistently faced selling pressure at every attempt to rise and has been pulled down to lower levels. This undermines investor confidence because repeatedly seeing lower highs makes the market direction appear downward. But if the price manages to break through this curve, if buyers can push the price above it, it signals that the long-standing pressure has been broken. This breakout moment often becomes the starting point of very strong upward moves. While the market was under seller control along the descending curve, this break shifts the momentum and restores investor confidence. Breaking a descending curve is important not only technically, but also emotionally. Such a breakout triggers the arrival of new buyers into the market. Investors who had previously avoided buying due to constant declines gain courage when convinced the trend has reversed. In the world of investing, these breakout points are often seen as the beginning of a new story. With the curve broken, investors perceive less risk and greater reward, which attracts more buyers. More buyers mean more demand, and this chain reaction pushes the price upward quickly. Moreover, a break of a descending curve is not only a short-term move. Often these breakouts signal long-term trend reversals. Even if the price has been in a downtrend for a long time, closing above the descending curve can mark the beginning of an entirely new uptrend. So when we say the price needs to break the descending curve, it emphasizes not only escaping the current pressure, but also unlocking much larger future upside potential. From a technical perspective, breaking the descending curve is like breaking a resistance line. This curve often represents one of the strongest resistances the price faces. Because investors repeatedly see selling pressure around this line, a sustained move above it creates a powerful sense of confidence. This confidence paves the way for the price to climb higher. For example, if the price has been trapped under the descending curve for a long time, a breakout unleashes pent-up buying pressure that can send it soaring rapidly. Looking deeper into the psychological aspect, most investors treat curves, lines, and trends on charts as a kind of visual roadmap. A descending curve tells them the downtrend continues. As long as this curve holds, they hesitate to buy. But when the price breaks it, it sparks the belief that the decline is over. This belief alone can be enough to drive the price higher, because market power lies in perception. Once investors believe the downtrend is finished, their own buying activity helps turn that belief into reality. That said, not every descending curve breakout results in the same level of strength. What matters is how the breakout occurs. If the price breaks the curve with strong volume, the breakout is much more reliable. Volume reflects market participation and interest. A breakout with high volume shows that it's not just a few investors, but a large group stepping in, which increases the likelihood of a sustained trend. So when we say the price needs to break the descending curve, it also implies that the breakout must be strong and convincing. Descending curves also play an important role in investor strategies. Many traders view a break of the descending curve as a buy signal because the probability of the price rising higher afterward is strong. That's why traders patiently wait for such a breakout, with the expectation that once it happens, the price will break free as if released from chains and move upward with strength.
This expectation is deeply rooted in investor psychology because it has been confirmed time and time again in the past. A breakout above a descending curve can also be supported by fundamental developments. For example, positive news, a major partnership, or an industry-wide revival can encourage investors to act more boldly. These factors boost investor confidence, reduce selling pressure, and increase buying pressure, making it easier for the price to break through the curve. When technical and fundamental factors align, the breakout becomes much more powerful. Finally, breaking the descending curve means overcoming the greatest obstacle in front of the price. Once that obstacle is cleared, the path becomes much more open. Investors start to set new targets, and the rapid surge in price after the breakout proves the strength of this setup. That's why the statement, "The price needs to break the descending curve," represents the most critical turning point investors await. Without this breakout, it's difficult to talk about a lasting uptrend. But once it happens, market dynamics change completely, and a new bullish phase begins. But we cannot make decisions based on only the curve, so let's take a look at the other metrics as well. Stay tuned.
The rising trend structure observed in the RSI indicator is an extremely critical technical analysis signal that shows the market is moving in a positive direction in terms of momentum. At this point, we are not only talking about the superficial fluctuations of price movements, but also the underlying balance of power at play. An oscillator like the RSI guides investors by measuring how strongly the price is under buying or selling pressure. If a clear rising trend has formed on the RSI indicator, and this trend line has been tested several times in the past while working in parallel with price movements, then this trend line actually functions like an invisible support line in the market. When the RSI value comes down to the support line and bounces, meaning it resists downward pressure and gains upward momentum again, it creates a very favorable scenario for investors. This is because it shows that the market wants to continue its upward move without losing momentum. The presence of an ascending trend line on the RSI indicates that buying power in the market is continuously increasing. For example, even if there are occasional corrections on the price chart, whenever the RSI value approaches this rising trend line and responds by moving upward again, it proves that buyers are still showing strong presence in the market and can easily absorb selling pressure. This strengthens the perception of a momentum-backed rally in the market. Because it is not enough for the price alone to rise, if the price increase is not supported by momentum, the rally may be temporary. However, the RSI touching its rising trend line and bouncing back upward proves that the price increase is supported by internal dynamics, namely strong momentum. The critical point here is that this rising trend observed on the RSI indicator also carries a very powerful psychological signal. Markets are shaped not only by mathematical formulas, but also by investor psychology. As the RSI line rises in line with a specific trend, the perception that the market is gaining strength becomes more established in the minds of investors. If the RSI line touches this rising trend line and then bounces, it acts as a kind of confidence boost for investors. This is because many investors watch the RSI trend line, and such a bounce prompts them to make new purchases, strengthen their positions, or place greater trust in the ongoing uptrend. This collective behavior naturally continues to push the price upward. From a technical analysis perspective, such a rising trend line on the RSI functions much like invisible support levels on the price chart. Normally, there is a support line on the price chart, and when the price comes down to it, it reacts. Similarly, there is a trend line on the RSI, and touching this line confirms that the market still has a strong structure in terms of momentum. If the RSI value bounces upward from this line, price charts generally show parallel new upward waves. In other words, the rising trend and bounce on the RSI function as a leading signal for price movements. In particular, in such cases, a bounce observed on the RSI indicator suggests that prices may gain stronger momentum in the future. Because if the RSI does not break this trend line, meaning it does not lose momentum, the price's upside potential remains equally strong. That is why most investors follow the trend lines on the RSI and interpret bounces from them as positive signals. Such bounces are considered buying opportunities in the market, which can accelerate the rally even further. Moreover, the sustained preservation of this rising trend on the RSI can also be seen as confirmation of a medium and long-term uptrend in the market, because the RSI not only reflects short-term fluctuations but also shows the broader structure of market momentum. If the RSI consistently adheres to a rising trend line and reaches higher levels after each bounce, it is a strong indication of a sustainable upward trend in the market. Therefore, temporary pullbacks in price should not worry investors. As long as the RSI maintains this rising trend, the overall momentum remains strong.
Psychologically, the RSI touching and bouncing from such a rising trend line also causes investors to see selling pressure as an opportunity. Because as long as the RSI line does not break, investors believe the upward momentum in the market continues. This results in limited selling and renewed buying, which strengthens the rally. At this point, the RSI indicator is not just a mathematical measurement tool, but also a powerful psychological factor influencing market participants' behavior. Another important point is that the rising trend on the RSI can give signals earlier than price movements. Sometimes, before a support line on the price chart is tested, or before the price itself shows direction, the RSI can touch its rising trend line and bounce.
The pennant formation is one of the most trusted continuation patterns in technical analysis and one that investors eagerly follow. This formation usually appears after a sharp and high-volume upward move during a short consolidation phase, showing that the price is compressing in a horizontal or slightly downward-sloping channel as if it is taking a rest. Visually, this compression resembles a small pennant attached to a flagpole, hence the name pennant formation. At its core, the pennant pattern signals that while the market may be pausing briefly, the bigger picture suggests the uptrend remains strong and another move is likely to come soon. At this point, the upper trend line of the formation emerges as a critical resistance. If the price manages to break this upper line strongly, it often signals the start of a new bullish wave, with the price expected to rise by the height of the pennant pole. The phrase, "a rise equal to the pole's length," refers to the idea that the sharp, steep climb before the formation can be repeated with the same intensity after the breakout. One of the strongest aspects of the pennant formation is that it allows investors to measure price targets with confidence. Once the breakout happens, investors simply take the pole's length and add it to the breakout point to estimate the target. This method is not only practical, but has also produced successful results in many cases. In your example, if the price breaks the upper pennant trend line, it is expected to rise directly by the length of the pole, which translates into an approximate 1,300% increase. This points to an extremely impressive potential rally and, especially in the cryptocurrency markets, represents extraordinary profit opportunities that excite investors and sometimes actually occur. Since cryptocurrencies are much more volatile than traditional markets, such massive percentage increases are possible. The 1,300% growth potential here is also a powerful psychological motivator for investors. Faced with such a possibility, people are more inclined to hold their positions longer, make new purchases, or fully ride the ongoing trend. There are other factors that strengthen the power of the pennant formation. For example, an increase in trading volume during the breakout is one of the most important elements supporting the validity of the pattern. If the price breaks the upper line with increasing volume, it shows not only a technical breakout, but also that market participants are collectively moving into buying. In such an environment, the likelihood of reaching the 1,300% target grows even stronger. Since most investors know this target, they tend to follow the rally in a more planned manner after the breakout, making additional entries gradually rather than panic buying. This helps the rally continue more steadily. When large investors, whales, also recognize and act on this formation, the price reaching its target becomes almost inevitable. Another factor sustaining the rally is market psychology. The pennant formation often reinforces confidence in the uptrend. When investors see that the market resumes upward movement after a brief correction, they believe the trend is still strong. Thus, the formation provides an advantage not just technically, but also psychologically. Investors adopt the mindset of "the trend is my friend" and continue to follow it. For crypto investors especially, who often aim for quick large gains, such formations are extremely appealing. A 1,300% increase represents the kind of leap many dream about on their path to financial freedom. That's why pennant formations are closely watched and often become the center of attention in the market. Another key point is that by nature, the pennant forms after a short-term consolidation. The price has already risen sharply, then taken a brief pause, and is preparing for another upward move. This shows that buyers are strong in the market while sellers can only exert temporary pressure. If sellers had been stronger, the price would likely have broken downward, invalidating the pennant. But the preservation of the pennant structure is a sign that buyers remain in control. That's why when the upper trend line breaks, the expected move is upward. The formation is inherently bullish, and that nature reveals itself powerfully at the breakout. For investors, approaching a potential 1,300% increase requires a strategic plan. Especially for technical traders, such a massive target often calls for taking profits gradually. Rarely does the price move in a single surge of that magnitude. Corrections usually occur along the way. However, these corrections don't undermine the overall trend, rather they indicate a healthy rally. The price may pause, consolidate, or even dip slightly several times on the path to 1,300%,
but the main scenario remains intact. The price ultimately reaches its target. This requires patience. Investors who read the pennant correctly and stick to their targets with patience are often rewarded significantly. Another crucial factor is the momentum of the breakout itself. If the breakout is strong and fast, it gives investors additional confidence. Sharp and sudden breakouts are signs that large buyers are entering the market. In such a case, even a massive 1,300% target can be reached relatively quickly. This has happened multiple times in the crypto market before. Bitcoin and many altcoins, after breaking out of pennant formations, have surged by hundreds or even thousands of percent. These past examples give investors confidence and strengthen the belief that the same scenario can happen again in the future. Finally, the pennant formation is not just a chart pattern. It is a concrete reflection of market psychology, the supply-demand balance, and trend strength. When the price breaks above the line and rushes upward as if freed from chains, it reflects investors' optimistic expectations for the market. That's why a 1,300% target carries not just technical, but also psychological weight. Investors' belief in the formation creates a domino effect in the market, causing the price to rise even faster than expected. For this reason, the pennant formation has always held a special place in technical analysis. It represents not only a graphical setup, but also the hopes and potential of the market's future.
Yes, friends. I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.